getting good at, I think, by now. We're having a very interesting session today. We have our distinguished guest visiting us from Houston, all the way from Houston. Shenoy, my peer there from Houston, president of the TiE Houston chapter, and Amy Henry, the charter member, and does a bunch of other things for TiE Dallas, including helping the TiE Angel Network. They have unique expertise in the area of energy, in the energy sector, and specifically alternative source of energy and whatnot. We have a lot of discussions. We thought maybe why not use this opportunity to get some more insights from them, because there's a lot of interest from Dallas also in that space. So we're going to keep this fairly informal, free format conversation, and have Ram Shenoy take the lead in going through some key points with Amy, and then we'll all chime in and ask our respective questions as it might seem it might be appropriate. So with that said, again, like I said, it's a small group today. Most of us know about TiE Dallas. Normally, I'll go through a little spiel of TiE Dallas, what we are all about, our programs, what we did recently, our upcoming events and all that. But I'm going to skip that part and jump right into our key topic of the day. So welcome once again, formally, Ram Shenoy and Amy Henry.
Thank you very much.
And we have a packed agenda tomorrow for us to go through our Angel Network and whatnot. But let's get on with today's session. And this is a TiE Tuesday session we have. Every other Tuesday, sometimes it's once a month, but we have different speakers come and talk about different things and areas of their expertise. And we also use this as pitch. We used to use this as pitch days, where startups will pitch to us, and then that becomes a funnel for us to look into in terms of where they will invest our mentoring, coaching, and dollars into. So anyway, with all that said, over to you, Ram.
Yeah, so thank you, Ram Viswanathan. Thank you both for George and Ram for hosting Amy and myself. We're really looking forward to the discussions we're going to have about our joint interest in setting up TiE Angels Texas as an activity between the chapters in Texas, which I think will be something very distinctive among all the TiE chapters. And it's one of the topics that I think we'd like to touch on in this roughly 45 minutes that we have here. Just speaking with you earlier, it's our understanding that your audience, your charter membership in Dallas has a number of people primarily with a background in the tech enterprise software sector, maybe a few life sciences, but you really don't have people who have spent their careers in oil and gas or energy. And so as we understand the topics, obviously angel investing is a topic of interest. Another topic we'd like to cover is just a little bit what's happening in the energy industry, and in particular in renewable energy and alternative sources. Actually, I'm going to be just the moderator and question. My background's oil and gas, and it'll come up in the conversation. But I really want to defer to my colleague, Amy Henry. So she's the co-founder and CEO of Eunike Ventures. It's an incubator. Well, it's got an interesting business model that we'll let Amy speak to. She's actually got a background in oil and gas too. And I think before we lead on to the gap in investing that Amy saw and the business model she's pioneered, we'll start with just having Amy telling us a little bit about her background. So why don't you do that?
Okay, great. Thank you, Ram. I'm trying to say which way do I look, right? Do I look at Ram? Do I look at the audience? So hello, everyone. Again, thank you for having us, right? I've been working closely with George, and I really appreciate, Ram, you being supportive and let us kind of, investigate how do we collectively work together on the investing side. So I love talking about me, not really, but like Ram said, I'm from originally probably about 25, but now it's getting close to 30 years in the energy background. So I started with Royal Dutch Shell. And so that was during a time when they were bringing people in from the outside. So I worked on the commercial side of the business, and specifically with the R&D and technology that was developed internally within Shell, taking our technology outside the labs, doing field demonstration tests, commercializing it, looking at our different commercial models. Basically, why do we fail so badly every time, right? And trying different vehicles and mechanisms. So that was, and then from there also was with Shell when we took tech out into unconventional. And started doing, field tests on that and isolation tests. And that was probably in the late 90s. But then I've worked throughout Shell, upstream, midstream, downstream, gas and power, and trading and the whole kind of value chain. Then I was also the global CFO for Petronas when they got into the unconventional business. They purchased Progress Energy up in Canada. I tell people I worked in Malaysia for a big project in Canada. It seems a really strange thing, but they wanted to see. Petronas was working on, I'm an NOC and I wanted to have an IOC mindset. So they wanted to learn, kind of from the mistakes, how do they approach commercialization, Progress Energy, I think at the time it was going to be about a $20 billion project, and then getting into Argentina and then in China. So, and I was also with Shell, I was with Shell Technology Ventures as well. So when we came back to the US in 2016, started spending some time in the ecosystem and donating time doing mentoring. And both my co-founder and I noticed there was this big gap. We saw some really interesting technologies that might be really rough, but people were having them pitched to VCs, right? And none of the customers were involved in that.
You may want to calibrate people a little bit. How long does it take to introduce a new technology in the oil and gas industry? Because we've got a whole bunch of
novices.
It's a long life cycle. So I would say, even Shell tries. So Shell runs Shell Game Changer, and that's early stage. It takes about 2 to 3 years in a fast case. Same way with Chevron. That adoption period, there are very, very many companies, even on the digital side, that are very well-funded companies, even Series B companies. And their sales cycle to add on a new customer, in many instances, will take them 2 years to add on another customer. It's very, very difficult. And this is the space we call the value of death. And this is why we said we really need more earlier stage engagement from customers from the energy standpoint, right? Ones that are willing to pay for field trials. A lot of them weren't paying. They keep the companies whole, keep their IP. Provide a natural springboard in which once these companies, can show that their technology has been validated by a particular energy player, then they have a natural group. So in the early stages, we had Statoil, we had Anadarko, we had Hess, we had TechnipFMC, all kind of in the energy and open innovation space. So they all agreed, listen, I'm not going to take IP from these companies. They're free to use our names and our logos. And we will share our field trial results. And then we kind of collectively look, how do we extend the runway? How do we increase the success of adoption? Can we split the the technology stacks up? Can we do more bench trials? How do we bring smarter capital in for these companies, right? So that was some of the things.
So maybe we want to, for the benefit of our audience, contrast just a little bit the Dallas ecosystem, the Dallas industrial sector makeup versus the Houston sector makeup. So roughly speaking, you'd say, would it be fair to say Houston is primarily oil and gas first, life sciences second, enterprise IT third. And that's really how our charter membership is broken up. We're really one third there. And then it's fair to say, I think that space is something topical, but it's always been, we've always had basically the supply chain of the space industry in and around Houston, right?
Yes, and that's correct. And then during this more recent time period, that's when the city of Houston brought in Accenture to do a longer term study for Houston, right? They wanted to, I don't want to say shake the oil and gas kind of focus, but they really wanted to look at where did Houston need to be going long term in terms of developing the smart city, the long-term growth, but keeping that diversified economy that Houston has, right?
So contrast for us, you said you came back in 2016. Think of just 5 years, 2016 to 2021. Talk about the incubators, VCs 5 years ago when you first came compared to now. What's been the change in Houston? And
I have to be nice, yeah, okay.
And then talk about why you chose to found your company during that period.
Okay. So I would say in Houston, the incubator accelerator space, you probably just had a handful, maybe 5 or 6, if at most.
In this particular
Houston,
sector or in general?
In general in Houston, right? Now, if I go forward to today, and I sit on, Houston's, we call it the Startup Development Organization. So it's all of these incubators, accelerators. Some of them are coming from, the universities like Rice have their own, like the Lilly Labs is one example, Alspark. We're probably getting close to 40 or 50.
Oh, wow.
Right. And part of this is also Houston was trying to draw in no names. So part of that, they brought in Greentown Labs. We've got, WeWorks there. We've got Plug and Play. We have Mass Challenge. We have Generator. And with the building of the ION, which is going to be a very large, it's been built, kind of community center was backed by the Rice Foundation. So we have a plethora of organizations. The problem with this is it's kind of like everyone running around, so no one knows what each other does, right? So how do you foster, collaboration? And how do I, if I'm a startup, who do I go to for what? I'm finding this very, very confusing. And for some of the startup community, they're primarily off-grid, so they're not even captured by the ecosystem. And then you see a plethora, and then Houston's been pushing engagement from VCs to get to come to Houston. So they want, the VCs from New York, East Coast, as well as West Coast with Silicon Valley. They want them to fly in basically and kind of hotel and come to see the startups, right? So they're trying to pull that magnet as they build up this ecosystem. So we have our own Houston VCs. But what we've seen is before you had just your traditional VCs, and even ones that were pre-revenue. So what's happened over the last 5 years is now VCs are becoming very, very picky. So they're becoming more like private equity. So the recurring revenue profile that you have to be able to demonstrate is in the millions, right, to get funded. So you have VCs that have grown into macro, what I call macro VCs, that almost the size of, like a PE. And they predominantly, if you look at the VC funding in the US last year, around 68% of the capital that was injected was solely for growth capital, right? Which means they're providing less and less seed funding. Angels are no longer angels. So during this whole time period, so angels are investing either in funds or fund of funds, or they're also moving towards what VCs are saying. You have to have this revenue profile or strong customer locked in before I'll invest in you. So that whole dynamic is then who's really working with these startups at an early stage? Who is going to make sure that this ecosystem continues to grow?
So tell us about Eunike Ventures and what's your thesis?
Oh, it's complicated. No. Well, it's several. One is to get energy companies to actually collaborate with one another in an open innovation, right? And our technology agenda that we work off of every year is a shared agenda. So when we do our open calls and we continuously look at companies, it's shared. So Technip or Equinor, Hess, anyone else says, we agree collectively to look for these technologies and getting the paid pilots, right? They're looking to try new technologies at a much faster rate. They need more commercialized technologies. That's their thesis.
So it might be worth, because You said that most of the audience is enterprise IT, right? So IT is probably used to open standards and open APIs and open interfaces, right? Horizontal. So maybe, Amy, you want to talk a little bit about how different this is for the typical oil and gas mindset. What would a TechnipFMC think of for its competitive advantage, proprietary technology or a Shell? Maybe you could just...
I would say previously, they would shy away from anything that's an open platform, even an open API, right? They strongly, historically, have believed in enterprise applications. I mean, I don't even know what year we could move it from Shell from a BlackBerry and actually use an iPhone. I mean, it wasn't that long ago. I mean, so those, it's really, but that has changed, and that has changed over the last 5 years. So when now I'll use Hess as an example. So their preferred partner of one of the, their vendor suppliers is Neighbors, and it's cloud, and also in the cloud. So part of their requirement with Neighbors now is they have to provide an open API environment. So that Hess, along with us, we look at technologies that allow those digital technologies to plug into that open API, right? So they can see kind of what additional technology and enhancements they can get through their existing service provider, right?
So, as I understand it, our audience is interested in alternative energy and maybe ESG and the implications go on. So maybe let's start with ESG, just because I think it's affecting all industries, not just oil and gas.
So I'll kind of start off because we work globally, and,
Right.
and it's about having partnerships and building communities, right? So we work with Canada, Norway, Business France, many other. It's about having the I call global energy bridges. So part of this is, it's kind of funny. So Canada asked me, this was recently, is ESG a new thing for the US? Has it been around a long time? And I said, yes, it's been around for like the last 15 years. We've called it something different. We talked about sustainability. We talked about it in our license to operate. It was a centerpiece. But really the easiest way for people to understand, and we look at ESG, it's not something separate. It's looking at how do we reduce our carbon footprint? How do we operate, from an operational excellence, top quartile operational excellence. And then in terms, you have certain metrics that you're reporting in terms of ESG. So a lot of your independent producers, or what, more of the pioneers and Diamondbacks and all this, some of the big items they're working on is methane reductions, GHG, and those kind of measures, right?
Yeah, so perhaps it's worth spending just a little bit of time, it may be a bit of a detour, but looking at it from the point of view of why are companies doing all this decarbonization activities, because it's investment risk, right? So for an oil and gas company, I think the simplest example is if you look at a Shell, which keeps, it has certain reserves on its balance sheet, right? An investor today looking at a Shell's balance sheet may say, you may be out of business in 5 years because governments will not let you produce your oil. So your valuation change. This is why it's a big deal in the oil and gas industry, because you have these potentially stranded assets, right? Now, it's kind of an open question whether in 5 years governments will
look at what just happened with the announcement that Biden came out with by 2020.
Well, that's the thing. Electric vehicles. Are you talking about the
50%?
The 50% electric vehicles, right? And so it's kind of an interesting thing, because and why this is interesting for all the entrepreneurs among us is because every one of these is a potential business opportunity, right? I mean, in ESG, for example, there are companies who don't have a clue about, and so there are other companies making money on designing ESG dashboards just to make sense of it. And actually, it's worthwhile studying the accounting standards for this, because you realize how complex this is. And anyone who can simplify that will be onto a money winner, right? With electric vehicles, you have to think about just the infrastructure needed to support the electric vehicles, not only the simple things like the charging, but certainly the Texas grid, after February, all of us experienced it, does nowhere near the resiliency to support any sort of reasonable population of electric vehicles. Actually, it wouldn't survive another winter, right? I mean, nothing has actually changed, right? So there are opportunities there. And we had a previous one where actually I think there is an entrepreneurial opportunity on how do you, on a private sector basis, make the grid more resilient if the government will fail to do so, right?
So there's like you said, there's many challenges. I mean, the concern with the ESG reporting is, as I look at this, right, my concern, also being the CPA in the room, is are we going to create another cottage industry like we did with SOX, right? And it's so complicated. Or people then approach it with a check the box exercise, right? Talk about the electric vehicles. I mean, we work with hydrogen companies, and even they don't believe that it's a possibility to go mainstream as the government is pushing this, right? So they're really, really big concerns. But if I talk about ESG, really the low hanging fruit is digital, right? The companies can start working now. Right. Is all those more of the pay as you go, more they call it the Uberization, even though I hate that term, of non-enterprise solutions, right? I put the digital solutions in the hands of the end user, right? And they can determine how broad and how wide they want and layer on top of their existing infrastructure. It's really quick implementation. I don't have these high implementation costs. I don't need a huge external team to be embedded in my company long term.
So it's going back to your Eunike Ventures, your incubator. So what percentage of the companies that you work with are in the future stuff that is coming out versus solving today's problems?
It's both. I mean, really, because you have a lot of these technologies that are currently working in, I'll call more of the oil and gas stack, but they have cross applications into the more the clean tech and beyond. And then people have to understand when we look at technologies, we're not just looking at energy, we're looking at biotech, we're looking at aerospace, we're looking at healthcare, we're looking at insurance, things that the Department of Defense are doing. And we've had a lot of discussions with our energy partners. So their concern is this: we need a lot of this technology that energy needs and everyone's talking about is going to be coming from outside the energy vertical. The big concern is it costs a lot to change. The management change in an oil and gas company is very long and it's very expensive. What's going to prevent this company then from leaving the vertical and going someplace else? It's a great starting point for them because they really if you can validate your technology in oil and gas in a really hard and harsh environment, you're good to pop into any vertical.
So you mentioned hydrogen, Amy. So maybe you could talk a little bit more about the companies you're doing in hydrogen. Maybe you'd comment at the popularity of hydrogen for funding right now. And
hot. Well, and this is our concern, and this is my concern with VCs. It's like the due diligence is going down for these companies. Normally, they would not. I would argue that they would not pass due diligence. Right? You've got all these funds that are popping up, and you've got even the oil and gas companies. Besides their own investments in CVCs, they're also it's about spreading your bets into these fund of funds, and they're and they typically have very young teams, so they know very little about the industry on some of the funds. The concern is the time it's going to take to actually validate this technology, and when the technology is truly going to be commercial and commercialized, or when the markets are there, because the markets have not yet been developed. The question we have is, are the VCs going to be able to have that staying power over a 7-year period, right? And so you're having entrepreneurs saying, okay, what route do I want to go in? I've got multiple routes. Even if I'm a hydrogen company, there's hydrogen tech that's applicable to oil and gas, as well as to just a pure clean tech play. which route am I going to go to? If I could go to oil and gas, no one's going to fund me. They won't, because I don't want to touch oil and gas. So I'll go the clean tech route. So the question then is, are we going to lose all of the technology that the oil and gas industry needs as they evolve their business model? It's not going to be there. So, I mean, it's not easy, right. It's not complicated, but there are some good hydrogen companies out there, but it's still very early stage. So when people talk about carbon capture and storage, I mean, oil and gas has been doing carbon capture for more than 10 years now, right? This is not something new, but really on the volumes that they're talking about, it's not, the technology is there, readiness level is there. It's just, it's not commercial to the scale, you know, where it's not economic, where you would deploy it.
So not to put too fine a point on it, but for our audience, if it's not already clear, I think if you're thinking about your typical digital software startup, you're probably talking in terms of capital requirements and speed to revenue, right? You're probably talking about thousands to tens of thousands to get started, hundreds of thousands in seed funding, maybe millions if in a Series A and maybe a Series B. And within 3 years or 4 years, with any luck, you're making revenue and you're on the growth curve acquiring customers. Sort of thing that Amy has been describing, right? So-called hard science companies. You're talking about millions in capital upfront, right?
Everything multiplied by
right, tens of millions.
Much more, yeah.
Right, and the reason this is important is when we talk about Silicon Valley VCs, they've typically arranged their financing around milestones that make sense for a software startup, but make absolutely no sense for the sequence of progression that, should I say, a physical products company, physical technology company has to go through. This has been one of the challenges. And, you know, hydrogen's a really interesting example. Why are people, and, you know, you're exactly right. I've seen a company which has some really smart scientists. They're getting a letter of intent for $55 million to build a pilot plant 3 years from now with nothing but calculations right now. This is your point on not very much due diligence.
Yeah.
But you know, you need something like 55 million to, you know, recruit the staff, pay them a salary, build the plant like that. You know, even I'm working with a little renewable energy storage thing. We're sort of raising 20 million upfront to do a demonstration.
So the definitions are very, very different, right? So when we say, if I ever in a digital company and I say work with a startup company, we use that very, very loosely. So like Ram is saying, one of the hydrogen companies we're working with now, they would be at a technology readiness level of say a 5 or a 6 maybe. Typically you won't do even field trials and demonstrations until a 7 or 8. They're already at a Series B and they've raised, from their A and B easily more than 50 million so far, right? So, it's big capital, big risk.
Which is should be no surprise to anyone because we're all in Texas. We saw Blue Origin launch, right? Blue Origin was $1 billion a year spent for several years to get to this point, right? They just had one person providing that $1 billion a year, but that's what it was.
But I'm telling you, whoever develops a solid digital tracking of the end-to-end of that system. So if you look at carbon capture, right, you could say I am neutralizing or I'm net zero. Okay, I don't want to argue about definitions. But if you still look at the activities that are surrounding that solution, I still have to have trucks. I still have to have people. In some instances, you can actually been increasing your carbon footprint. Right. It's how you look at it and what fence you've drawn around and what you're saying you're net zero. You still have concrete. Concrete has carbon content. Right? Mm-hmm. Okay. We still haven't gotten rid of concrete. Still, all these other materials.
It's not going away any sooner.
It's not going away.
This begs another question of all the initial investment is multiplied X number of times. What are the exit values like compared to a software company?
So we're looking at renewable energy storage because we think it's $1 trillion opportunity. That's why, right? I mean, if you look at what it takes to get to 100% renewable grid, so there are really fundamental challenges. It's not like you can just keep adding wind and solar because the grid will not tolerate it, because wind and solar are so-called intermittent or variable. Basically, they only generate power when the sun shines and the wind blows. But unfortunately, when they generate power is not when the demand is there. So you have to have some sort of storage buffer to be able to provide power to dispatch on demand, right? And today's grid, particularly the Texas grid, is not in any way near shape. And the opportunities that batteries, even though they have impressive cost reductions, will not scale to the level of gigawatt hours or terawatt hours. I mean, you just add up the cost of, basically you can understand that more storage you need a larger battery. The cost of the battery will scale with the size of the battery, right? So you add up that and you do the arithmetic and you find that batteries will be about 100 to 1,000 times more expensive unless they come down a factor of 100 or 1,000. You know, lithium batteries will plateau out in about 5 years at about $50 per kilowatt hour.
And then not even going to the discussion of what are the components that go into making those batteries, and that becomes another.
Right, and we're not talking about the carbon footprint of lithium mining, mining the rare earth metals. We're leaving all of that aside, right? So if you believe that the world has to really eliminate fossil fuels and you sort of look at the market opportunity, that's why you would take this kind of risk to go through that, right? Now that being said, there's no assurance that we'll actually succeed in that, but the opportunity is there.
So if I may follow up on that note, right? If you bring everything to full circle, given the long gestation times, somewhat immature state of underlying technologies and the landscape, and number three, I think uncertain regulatory framework. What would you recommend for investors? There's two groups: investors, angels.
Angels, yeah.
Number one. Number two, entrepreneurs that are out there that are trying to target this sector. What would be your take on that in terms of advice and suggestions?
So may I take one on the entrepreneurs? So the government has just announced a $4 trillion infrastructure. They are throwing a lot of money, which is available for entrepreneurs. The reason hydrogen is getting funded. So you should look at the DOE US Department of Energy webpage and look at the awards they've made to startups for different types of hydrogen. I don't know why hydrogen is the flavor of the month today, but next month it'll be something different. But it'll all be about alternative energy sources and the auxiliary technologies to make that there. And there is a ton of money, and it's no different. The reason. The magnitude of that package is comparable to the New Deal that FDR did, way back. And
so it's more public money than private money.
Well, don't forget that Tesla started with the Department of Energy Loan Guarantee Program. The reason Tesla actually exists today is actually because of the loan guarantees that the US Department of Energy made. Everyone talks about Solyndra, which was the failure. No one talks about Tesla, which is also backed by US DOE loan guarantees. And that's what enabled them to get the financing to, in their early years, right? So the first thing I'd say to entrepreneurs is, actually, there's a lot of subsidiary funding, and unlike the previous 5 or 10 years when government funding was scarce, in this coming period, it will be actually abundant. It's just navigating that. And you can then bring private investors on the top of that. That would be my
I'll
advice.
give you kind of two examples, okay? And it shows you where the sentiment has changed. So in 2018, as part of our screening and health check process we like this hydrogen company. Why did we like it? The technology came out of the university, right? Breakthrough Ventures, which is one of Bill Gates had invested in it. They were extremely early stage, but who knows? It's a crapshoot. However, the reason why we liked it is it was a platform technology and they had hit every technical milestone along the way. At that particular time, we were desperately trying to help them. They were early stage. We're not that early stage. They were trying to raise $100,000, and I'm going to tell you, they couldn't do it. We could not get the support from anyone. Shell's answered too soon. Equinor said, I haven't developed my hydrogen strategy. We went round and round, just 100,000, okay? Now they're ready to raise Series B. Equinor closes it. Well, we did the technical and commercial due diligence. They closed their investment within 3 to 4 weeks. Normally, it takes them a minimum of 3 to 6 months. Gives you an idea how things
Timing
change.
is everything.
And we said it would have. You should have. You know how much you've overpaid now? You've entered at Series B. We told you to enter at Series pre-seed, right? So it's very difficult to garner,
How long
that-
ago was that?
This was in 2018, towards the
Not
end of
that long,
2018.
a couple of years.
Yeah, even the small and mid-sized VCs, it was very difficult trying to get investment, right? So that's very, very difficult. Right. And then going to the government funding. So we work with ARPA-E, which obviously is support of under the DOE program. And so what ARPA-E has then developed for the last kind of couple years is an industry program, and it's a matching program, right?
Okay. So,
if they have a technology or if it's in their list of technology, the government wants to see developed. And if an industry partner says, I'm interested, and we want to do a field trial, they'll match it. So if it's going to cost Shell $1 million, ARPA-E will match it with $1 million, right? And it's provided so that the ARPA-E and DOE technologies don't drop off and die once they finish their R&D, but it's also then working with industry to kind of lift the burden off of industry because it's very, very expensive to do these field trials.
So your point is really well made, Ram, that actually these types of enterprises entail all sorts of risk that no private institution can countenance. I think what we're saying is government at the right time actually is a backstop to many of these risks. So the loan guarantees allows you to get project financing. Amy talked about matching funding, which allows private investors to come and essentially get 2 for 1 or something like that, right? That being said, they're not as quick return as these digital enterprises. That's sure. The challenge, I would say, you have a different challenge with digital enterprises, which is where to find the winning opportunity, because it's probably arguably more crowded and there's more talented people looking through that, right? So.
Yeah, and we would like to see more of a mass consolidation.
Let's open up for questions from the audience. There's a number of angels, some entrepreneurs out there. So folks, any questions, thoughts, comments, questions?
Yeah, I actually threw a couple in the chat window. I don't know if it's worth just reading off but I was just curious on your view on mandatory and voluntary offsets. And then if you have a view on biofuels and the D3 and the D5 RINs.
Well, I will say biofuels a year ago, if I were to raise biofuels a year and a half ago or so with my industry partners, I would have been thrown out of the room, right? Because we look at the full energy value chain, right? Both from traditional all the way to clean tech, material science, the whole bit. So now we've got companies, the energy companies want to now start to relook at biofuels, right? The whole offset credits, that's still very, very early stage, yeah. And there needs to be more discussion on that. and those parameters. And so, you know, there've been a few kind of community discussions for people that are modeling and looking at that right now in Houston, but it's more of what I call an academic exercise right now. It's very, very academic, not from getting into practical.
So I'll make a comment on biofuels. You know, the real consistent interest I've seen really has been from those industries where security of energy supply trumps everything else. So people like the US military, I've always had a consistent, because, you know, the US military has had a really clear position about climate change being a national security risk. And so they've got a pretty serious program around it. I have not really seen biofuels being really competitive in commercial markets outside security of energy supply type, you know, critical energy supply industries.
Well, yeah, I would argue that the reason why they're being looked at again, because everything right now is who the hell knows. I mean, really, if you're brutally honest. Right. So if I want to kind of re-hedge the bets and trying to figure out kind of where's my new business model, where does my, you know, kind of domain expertise going to fit, that's why it's being reopened again. You know, it's another alternative kind of.
And then on the offset credits, did you have a particular industries in mind, or was that a general question?
Yeah, I mean, I think you were talking about carbon engineering earlier. I'm not sure 100%, but with Microsoft, Bill Gates, and then effectively, you know, Microsoft announces they're buying forestry to meet their 2030 goals, and now they're signing deals on direct air capture and a few other things to just try to get to a point where I'm just curious if there's enough goodwill in the large corporates. And I'm the one probably Dallas based energy guy, so sorry, but as an independent developer, it's just interesting to me on where the tailwinds are right now and where it could be from if you could get in with the large corporates. I mean, Eunike Ventures just spun out, right? They're doing everything around carbon pipelines and a bunch of stuff right now. It just seems like a really interesting time where you could almost try to swing for the fences, and if you have the right partners.
Well, I mean, I think it's interesting. I mean, when I was talking to Urtech this week, and we were talking, and people are like, you know, why isn't oil and gas and energy doing more? And you come up with really interesting solutions. So you've got the flaring issue. And when I've got flaring in traditional oil and gas settings, depends on what state I am, I have certain limitations. And then when I do that, I start to shut in wells, and then I don't develop. So we have validated technology, spend a lot of time doing a business use case where you've got technology where you can take the flared gas and convert it to electricity. Beautiful, wonderful, right? And then you can open up that. Now, what do I do with electricity? I'm not going to do Bitcoin. Oh no. I mean, that's like, oh freak, okay? I'm going to get slammed, right? Externals for doing that. Co-ops aren't required to purchase this electricity. It's really not an oil and gas problem, but we're sitting there brainstorming and looking at it technically, and what are the other things that we can do with electricity to get this technology adopted, to get a reduced carbon footprint, right? And ESG and all the right things that they should be doing. But it's all the solutioning that has to be figured out that may not be owned by me. So I've got to start talking to other companies, the electrical, the grid, you know, how do I get into those discussions where I haven't had to do that anymore?
Right. Yeah, I think, you know, Amy's answer sort of dovetails into what I was going to say, which is I think this is highly regional. So I see oil and gas operators in the state of California highly motivated because of the LCFS and what is it, the 45Q, whatever. You probably
the D3 RINs is cellulosic biofuel. The 45Q is carbon capture, right?
Right.
But that's still just a tax subsidy, so.
Right. Well, what I'm saying is that's where I see the activity. The state that's driving behavior is where I see the activity. And on your comment on Microsoft, you know, one thing I'd be interested in your take on is I've seen all the major data center owners actually make a statement saying, go something like this, I'm paraphrasing, but we will have 100% our operations 100% directly powered by renewables with no offsets by year X. And year X is typically 2025, 2030, 2035, depending on whether it's Google, Amazon, whatever, right? And so I've seen them, what I would say is their reforestation thing and so on is them hedging their risks, but they've actually made statements to their shareholders saying, actually, we will be 100% renewable without any offsets by a certain period of time. So I've read their, in fact, they're kind of our first early adopter target customers for energy storage because we think they're the only ones, they can't possibly make their target without really large scale terawatt hour storage.
But you do have some major corporates, right? Really going into early stage and
Right.
looking at all options. I mean, we're having some discussion. I think it'll be interesting to talk about it at a later time, but they're doing a complete business model shift and looking at various avenues, but they're starting at a TRL3, right? And then how do we work that full value chain? So it's very interesting. So there are major corporates. Everything's changing so fast. Everyone's changing their approach and their model.
Right.
Well, let's just to piggyback on, because that's what's interesting, right? I think in the next 10 years, the 2030, 2050 goals, they're not going to be able to do it on their own, right? So everything from energy as a service, it feels like everyone's willing to try different things right now, which hasn't historically been the case. So it's anyway, it's interesting, right? Is biomass power generation considered renewable, if they're running data centers off of it? Are we still chopping down forest, or do you chalk that up to a California forest management plan and it's saving houses from burning? There's just it's a very opaque conversation right now.
The UK's done a lot of studies on this, and this hasn't really hit the landscape and kind of mainstream discussion. So a lot of these technologies are going to require a lot of land use, right? And so certain countries are more apt for those particular technologies. So then you have to look at what are other uses. Am I willing to give up my agricultural land, right, to do farming versus having a clean tech facility built out? So I think you're going to see smaller scale eventually,
right,
kind of build outs of this because of that. You're going to have competing
right.
interests of the community, right? And which one is going to win, and how are you going to balance this whole equation?
Well, I could nerd out on this for hours, so I'm going to go ahead and go back on mute and see if there's any other questions. Sorry.
Can I ask a question, Ram, on that topic, because it's a very interesting topic? Do y'all, Ram and Amy, do y'all have views on liquid cooling of data centers and startups like Isotope? Have y'all looked at that? Because from a data center cooling perspective, that's another strategy that we have been looking at, and there's a huge amount of funding that is going into that space to cool computer gear, if you may, including we're looking at submerging processors in specially formulated fluids that flow through the tubes, and it results in fairly significant cooling effect, in terms of liquid cooling. Have y'all looked at that? Because we are encountering several startups that come and present to us with very attractive cooling guidance.
Now we haven't. I mean, it's part of a discussion. This is where energy companies would say, I would look at my component, my suppliers, like your HPs of this world. So that was when discussions at the last oil and gas OGGN, which they say is the world's webcast, and that was some of the discussions of looking at that.
Yeah.
So energy is taking some of those issues and technology and saying, okay, whoever it is, like an HP, you go figure this out for me, right? This is where I'm kind of letting you solve this. It doesn't make sense for me to look at this technology. Now, we have pendulum swings. So we have technology that we look at that would be kind of carved out to the domain of oil field service providers. But now companies have said, I want to look at everything, right? And then once we prove it out, then I'm going to go demand my oil field service providers then embed this technology into their products and services. So,
right.
I'd be love to.
Yeah.
I mean, our team would love to have a conversation with you, but
So-
I can't even get energy companies to talk about cybersecurity at this point in time, right? I mean, because there's so many. It's an issue. Am I going to tackle, right? You know.
Yeah, so one of my startups has looked at cooling things. Like I said, we're working on energy storage, and our target market is data centers because we think they're early adopters. And, as you sort of implied, data centers are the one sector that have just been growing in spite of COVID and probably accelerating. So they're a huge target. We have looked at different types of liquid cooling. And you're right, there is an opportunity to standardize. Although data center construction and equipment is pretty commoditized already. And while there are people who are first and foremost worried about sustainability, like the Facebook, Amazon, Google, and Microsoft, if you look at the majority of data center operators, they're really price sensitive. And it's really difficult to get a new technology to be price competitive. That's the challenge they'll have. But it's a worthwhile offline conversation. We're doing a pilot with Intel, which is public.
Okay. And not to prolong that, but just one other thought. The banks we serve, they have very strong ESG goals. So when they procure from us, and we are able to communicate the amount of value they can create, so they are able to, there is a process, and again, Amy, CPAs come into play there. They're able to quantify the amount of benefit that we are giving to them, and that then reflects fairly in their annual reports and shows progress. So we are finding some, Ram, we can share an offline and have the conversation, but that's an area of interest for many of the large data center companies.
Well, one of the reasons it's a high value potential opportunities, chips are getting hotter actually, right? So if you look at Intel's new chips, they don't even run at the optimum temperature now because they can't cool them fast enough. So if you have access to superior, and the only reason I talk to Intel about Intel right now is they have a greater than 95% of the chip share in data centers. So they are like really dominant. That's why I'm talking about Intel, right? If you can sort of persuade Intel on this, then you're basically done. I think it's really quite interesting. If you've got a superior cooling technology that allows them to run hotter so that you get higher CPU rates, then that's a really highly valuable performance attribute.
But Sunny did touch on the point that energy companies are going back to their SCM and procurement, right? And looking at tracking of all their contractual relationships and the ESG tracking that they need and recording that they need to do. So
there's a whole bunch of startups around chain of custody of verification, right? Of carbon trail. So is this electron carbon free or whatever?
Yeah, so earlier when you were mentioning about the type of investments for the energy technology companies, you mentioned compared to the normal technology companies, it runs into millions, where the other ones could be in the hundreds of thousands. So is there any statistics that shows that when you have such high investments going in, the success rate is higher, or like it's kind of closer to getting or starting to get returns? Any statistics that shows that?
Well, I would argue, we've bought into the argument that unicorns are a good thing. And Silicon Valley has sold us on that. And actually, if you look at the track record of the revenue coming from the unicorns, it's terrible. Right. And this great article talks about camels versus unicorns, right?
Can I make a reference? I'm sure because you're all IT, you have a great IT people, you must know this, right? There's this IT productivity paradox. You know what I'm talking about? That basically companies have never really got the return on investment on all the investment they made in enterprise IT over the last 40 years. So SAP and Oracle are making money. The company that invests in their software actually don't get the returns in their businesses, right?
Yes. And statistically, people
Ram,
have.
we need an entire day to respond to that paradox.
Oh, yeah. I'm going to keep quiet.
But you have to have, like on energy company investments, actually those that act more like camels. And it's a very interesting article if you look at it. Those that use less capital are actually more successful than those that raise larger amounts of capital, longer term.
Yeah, but just to balance it, I will just say, I don't have any data, but I will say the oil and gas industry's record, if you're going to do it by return on investment, it's pitiful. It's just bad, right? That they've put, and actually objectively, you can see that in stock prices, right? The oil and gas industry returns have been really bad. So you can say in the aggregate, whatever they've invested in innovation has not returned adequately to shareholders over the long term, right? That's just.
And then I'll do the contra. I gotta be controversial, right? So I will say institutional investors historically have driven some of those outcomes. So if I'll go back to Shell, when I was doing investor relations, Shell had a portfolio of renewables, and this was back in 2005. Why did we get the portfolio? Because our institutional shareholders said, you've got too much cash, okay? Either you stop with this crap investing in renewables and wasting our money, either give us more dividends, or you take your cash and you invest it in your core traditional activities. Shell's response was like, I got it, right? So this is what I'm kind of seeing. So I'm kind of curious to see how our institutional investors who drive these discussions with the large corporates going to act after 7 years from now. Yeah. Are they going to be willing to, the big ones will always keep hard to the dividend policy, right? They'll throw people out, even Exxon got rid of the 401k because they wanted to hold true to the dividend policy. But how are they going to respond? Is the pendulum then going to swing the other way? It's just a real question we have.
So I think this whole topic or range of topics is so loaded, and it's compared to legacy energy industry infrastructure. Now the way the transition is happening, it's much more multidisciplinary and affects every industry. Just in this conversation, short conversation, we touched construction, agriculture, computing, and we probably every industry imaginable is being touched in some shape or form. And in software, in our own situation where our software is deployed in construction, remodeling, and so on, and we are looking at an offshoot of the software which will be specifically for green building. So our software will look at assembling green material manufacturers, the installation codes and procedures involved, and that whole ecosystem is very nascent. It's only now taking shape. We don't know who are the players, how long it's going to take. We don't know. And another example that comes to mind. Yesterday, I was having a conversation with my daughter, and I was reading a report about the water industry. And I would like to get your opinion on that, actually, frankly. Apparently, the water bottles that we ourselves guilty of that. We're consuming water from water bottles. Apparently, that is 1,000 times more harmful to the environment than the water that we get from tap water. And I don't know if that statistic is correct or not, but apparently, so every industry is.
I just want to stir them up. Where is our largest carbon capture system? Where is it?
Where is it? That's a good question.
Where is it? A natural occurring carbon capture system. The sea and the ocean. How much do you hear anyone talking about that? Not a lot, right? Because if we don't fix that piece of the equation, all the stuff that we're doing right now ain't going to make a difference by 2050. So, but it's true. Water is very, very important, right? And that is, the sea and the ocean is part of a natural kind of carbon capture, sequestration that's naturally occurring. But we're also not, our governments aren't focusing on all of that. So a lot of politics and.
So suffice it to say, every industry is going to be impacted in some way or the other. They're all going to have internal mandates or government imposed mandates on reducing.
Or a price on carbon or something, right? You see the true cost of everybody's pollution being passed on to them, right? If you could ever figure that out.
So, I mean, if I take just a smaller producer, so like a Diamondback, another, I mean, if you talk to a lot of the independents, you know, their external messaging has dramatically changed. Now, I don't know if I really believe they're going to be able to hold true to it because of market forces, right? So they're saying, you know, we're to our shareholders, we're not going to go through these high ups and downs. So even if there's a price increase, we're going to stay steady to only a 5% increase in production. Okay. We'll see. And then they're kind of leaning towards more of the IOC model. We are going to be targeting returning about half back to our shareholders, right? And then at the same time, they're now saying, which I think is good, some of this is good, we need to be reframing the discussion of all of these issues, you know, externally. You know, we cannot do what we've done historically and keep quiet. So if we talk about flaring, for example, you know, they've really tackled a lot about it in upstream, but where you have the big issues is on midstream.
Right.
So it's not, they're saying we can't just say, oh, it's not in my backyard. You know, midstream, you go figure out. We need to take a pivotal role and be driving and pushing that engagement through the next section of the value chain with the midstream section, right? So there is a lot of discussion and changes. We just don't know how our market force is then going to impact. Can they stay to it? Yeah.
But I guess to whichever side of the debate you might fall in terms of the magnitude of the impact on the globe, the earth and whatnot, I think it's fair to say there is opportunity.
Lots of opportunity.
And to leave it on a positive note, to see our job is to go figure out where those opportunities are and whether it's small or big, and then
there's a huge opportunity in early stage investing and pre-seed because everyone has left that space pretty much, right? And so it's, you know, startups have said, okay, listen, I want smart capital. I really want smart capital is what they're saying. They're moving. I mean, I had one startup, actually I didn't tell you, the sued Techstars to get their equity back, and they got it back, right? So, you know, because I need help all the way through the adoption process. I want people that can be mentors to me. It's not just about money. You know, what is the knowledge that they can bring to me and help me kind of figure out how to grow and then commercialize this. And this is where you tie it back to our thematics about education, mentoring, you know, investing into that. Because this is where the big opportunity, and that's really, if you look at it, where you get your biggest upswing in returns. Right.
Yeah, that's I fully agree. That's why VC doesn't even think about mentoring or helping. Right. So if you're making money is your only objective, go to VC and do it. This is all about making the startups successful. That's why we should be doing. That's coming back to the TiE Angels program, right? So that's why we're saying if our whole goal is we can all go invest in fund of funds and be done with it, right? So that's not what it's all about. Because VCs, all of us have dealt with them. They have no single bone in their body to mentor anybody. They're all about.
And as Amy was saying earlier, the whole thing has shifted. Whether the size of checks or the investment philosophy that has changed from what it used to be to where it is now. So we are actually, as angels, playing the role of what VCs might have played decades ago, years ago, what have you. So
they don't do any early stage investing anymore.
Any other questions? I want to, before we close the session, fascinating discussion, obviously, and we can go on and on. There are so many tangents, so many tangents, but any other questions, folks? We are a few minutes on top of the hour, but
I do see Ram.
I just have a newbie question. Sorry, this is my first one. I just joined last week as an angel. Do we share?
By the way, welcome, Roshan. Welcome.
Thank you. I know George was going to make the intro. I know we haven't been introed yet, but do we share contact information and everything after this for follow-ups?
Absolutely.
Yeah. Okay. Yeah. Cool. It's nice.
And then we change our phone number. No.
I have lots of questions.
Very good.
So Ram, I was going to say there are a lot of startup opportunities here, software and all that.
Sure.
they have the expertise in the industry.
Yeah.
We don't normally go to.
Yeah,
So there's a natural affinity to tie
Absolutely.
the two chapters together.
absolutely.
Like Texas.
Right.
Yeah,
And we have lots of inbound companies too,
right.
looking to come into
right.
North America, and Texas is a natural landing
Right.
space. Yeah.
and then one other thing we didn't
Mhm.
touch on today, and we didn't have the time for it, is the social impact. I think you have a certain interest in that area, but
Oh,
maybe
yeah.
we can do it at another time.
Yeah.
That's really another very interesting angle that we need to pursue.
Yeah, perhaps another thing you could do, is you have a regular program, maybe the audience here.
Right.
We try to do a promotion here, but I think Houston has also good programs that we can tap into.
We're happy to, we'll just keep it.
Yeah, I mean, this is a great another example of how chapters can come together and collaborate. And I'm going to bring this up with Vijay and others and say, this is what we did here, and
Right.
hopefully it's a great start to more things to
I
come.
normally join some of their programs. They're
Yeah.
very informative.
Yeah.
Get more round tables. I like contrarian, right? You
Yeah.
know? To have a bit of a debate, you know.
Right, so
So-
maybe let them all go.
Yeah, some of us are getting together tomorrow and continue the discussion, angels and all that. But if there are no other questions, we'll wrap it up here. But one last call. Any other questions, folks? Navy, Eugenia, Sunny, Roshan.
Thank you. No, thank you so much. This was very, very, very nice. Thank you. Appreciate you guys coming over.
Oh, no, we enjoy it, yeah.
Yep. Thank you.
Thank you.
Okay, thank you.
Thank
Thank you,
you,
everyone.
everyone.
Thank you.
Thank you.
Bye. Thank you,
Bye.
Kim.
Thank
Thanks,
you.
everyone.
See you. See you later. Bye-bye.
Bye.
All right. What is mine?
I like the new joiner, right? Yeah, I like him.
Yeah, there's only two guys.
Very inquisitive. and,
Right.
There are two guys who, from the company, one was supposed to.
Right.
Raj. So they'll be good.
Yeah. They'd be good to connect with.
Between people.
Yeah.
because you could see his mind thinking.
Yeah.
So they're both part of this group called Dynamic Daisies.
Oh, okay.
Oh, is he? Okay. Is he's part of the Dynamic Daisies? Okay.
Dynamic Daisies.
Yeah, he and the other guy,